All right, welcome everybody. This is going to be a webinar based on Impulse Entries 3.0. We've already done Impulse Entries 1.0 and 2.0, where we go over the basics of what Impulse Entries are, why we look for them. Mostly we look for them for counter trend trade. If you're new and this is the first time you're hearing about Impulse Entries, or this is the first time you are watching an Impulse Entries webinar or this entire concept, I would say maybe to go over the basics first in the database and then maybe watch this, because this is a advanced webinar here. Some people who already know about Impulse Entries, this is going to be a short refresher for you. This is going to go for about an hour. It's a presentation style webinar, and I do encourage people to make notes. Making notes is going to be really, really important. At the same time, after this, we will go through a simulation session, and that's also going to go for about an hour and a half. So total on this entire session is going to be for about 2 hours, 2.5 hours, so it's like a big long movie with no ads. So let's continue on over here. Let's see. So we are recording. Everything is good. I can't hear anything. Is it just me? Yes. Oh. All right, everybody. Welcome. Welcome to the Impulse Entries 3.0 webinar. This is going to be an advanced section. So if you're new to this concept of Impulse Entries, I would maybe encourage you to go over the basics in the database, to go over the basics of Impulse Entries first. We have 2 webinars already in there, the Impulse Entries 1.0 and 2.0. They basically explain the basics of Impulse Entries and what the concept really is, and why we really use Impulse Entries. If this is the first time you're hearing about this concept as well, I would say maybe go through that first, because this is an advanced section here, so there's a very high chance that during this webinar you may get lost, or you may ask some very, very basic questions. Again, no questions will be answered during the presentation, because all questions that you may have, they will be answered without you even asking them. I promise you, this is how it goes, right? In the end, however, if some question is not answered, then we're going to open the floor and we will go through those questions as well. Secondly, this section is going to be a presentation style section that's going to run for about an hour, and then after this we're going to have a simulation session, and that simulation session is going to run for about another hour and a half. So in total it's going to be almost like a 2.5 hour session, like a good long movie, but with no ads. So that's what we're going to continue here. So let's see. So we got everyone coming in. Awesome. Perfect. All right. Let's get this started. So first of all, when we talk about Impulse Entries, we need to understand, what do we know about candles, because when we're looking at the charts, we're looking at the candles, and if we can't understand candles, then we can't understand where prices are going to go. Because when we talk about indicators are basically lagging behind candles, so it's really important to understand what candles mean. First of all, we need to understand what big body candles mean. So whenever you have big body candles always mean there's a lot of volume in the market. Usually what happens is that we have smaller body candles. Small body candles mean there's small volume. At the same time, as the bodies of candles start to get smaller, that's an indication that the volume is decreasing, right? So sometimes what may happen is that we may see a candle form like this, a big bullish candle like this, right? Then slowly we end up seeing that the candle bodies, they start to get smaller and smaller. So when the candle bodies are getting smaller and smaller, you're more prone to say that, okay, if we missed out on this move up, we may want to enter right over here in the anticipation that price is going to continue moving bullish, right? But when we look at the way the candles are forming, we see that this is a high volume candle. Small body candle means the volume is dying, and then again the volume is dying a little bit. So the biggest mistake I've seen people make in the charts is that they buy at the very top. What this means is that you'll try to buy at the very top over here, and then you'll see a candle retrace, and then you end up saying, oh man, I took a buy, candles were bullish, and it's going against me. It's going against you because the candle bodies are getting smaller, which means the volume moving up is decreasing, right? So one most important note to make is that whenever price moves away from a zone in a bullish fashion, or whenever price moves from a zone in a bearish fashion, there's a higher probability that there's going to be a retracement coming, right? The further away the distance is between the zone and the candle, the higher the probability there's going to be some sort of a retracement coming down to possibly create a support to move back up. Right? So that's something to identify. So whenever you're looking at candles moving further away from a zone and you've missed out on the move, just know that there will be a retracement, and that's going to be your opportunity to kind of enter at a support, or to retest the high, or maybe look for some sort of an impulse entry to move down counter trend. Candles with no wicks usually mean there's no range for the next candles. This is, a lot of people make a lot of mistakes on this, so we're going to go over this right now. So usually we have a candle with a nice healthy body with the wick at the top and the wick at the bottom, right? Let's say, for example, this is a bullish candle. If this is a bullish candle, there's a very high probability that the next candle is going to continue moving up to fill this wick right over here. If this is a 4-hour candle or a daily candle, you need to understand how the market structure is formed in the smaller time frames, so you can understand what goes into creating a candle with the wick on the top. That's mentioned in the basic sections of the unlearn and relearn section. So this is what we got to talk about first. When we're taking trades, this is the ideal candle that we want to see with the wick at the top and the wick at the bottom, because if we see that, okay, the next candle has to move bullish, we understand that, okay, if the next candle has to move up, it has to respect the low of this current candle and break this high, because we all know that whenever price moves in an uptrend, it's going to make a higher high, it's going to make a lower high, higher high, lower high, or higher low, higher high, and so on and so forth. And that's how the candles are basically going to be formed, right? A candle is going to be bullish. The next one is going to respect the low of the previous candle, and you're going to see another higher high and a higher low. Same thing goes with the next one. We're going to continue moving up, and the same goes for when candles move bearish, right? Very basic ideas, no confusion here based to how candles move in trends and so forth. Next, we have what happens when a candle closes with no wick on the top. Right? Whenever a candle closes with no wick on the top, on the smaller time frames, you have to understand this, right? This is what happened. On the smaller time frames, you had a candle move up, and then you had a candle that moved bullish, but it closed with no wick on the top. So this means there's no range for the next candle to go up. You always need a range in the market for price to move in that direction, right? So whenever a candle, there's no range on the top, or if there's no wick on the top, there's a very high probability that the candle after that may form something like this, like you may have a bearish candle like this. I know that a lot of people have been caught in situations like this, like a candle is going to close with no wick, and normally the idea is that, okay, when a candle has no wick on the top, that means there's a lot of bullish volume. No, that doesn't mean there's a lot of, at some point there is, but for most probably, this means that price went up and then abruptly it just stopped at this level. When we look at the candle before this, you see that there was a candle that went bullish, retraced, and then closed at this point, giving the opportunity for the next candles to continue moving up. Now, when you see a candle closing with no wick on the top on the 5-minute time frame or the 15-minute time frame, see, I'm already getting questions about, sir, please don't answer. You know what? I'm going to try to disable the chat here. Perfect. So no one can ask questions. All questions are going to be answered, guys, without you even asking them. Trust me. Just patient, just relax, right? So whenever you have a candle closing with no wick on the, let's say, the 15-minute time frame or the 5-minute time frame, those are weak confirmation time frames, right? There's a very high probability that the next candle may continue breaking the high, but normally, when I'm personally looking at a trade, or when I'm looking at a, way to enter a trade at that point on, let's say, the 30-minute, for this part, I'm going to stay away. Right? Whenever you see a candle closing with no wick on the top on the 30-minute time frame, I just look at that and say, okay, like, you know what? There's a higher probability for the next candle to continue down or to continue up, which means there's a 50-50 chance for it to move up or down. So at that point, it's better to just wait for the next candle to form to give you a clear direction. But when you see this happen on, let's say, the 15-minute or the 5-minute, it's a weak confirmation time frame, so there's a very high chances it may continue moving bullish. Now, when we talk about impulse entries, right, this is only specific to, I would say, partly to the 15-minute, but mostly to the 30-minute time frame, right? So this is what's going to happen. Whenever you have a candle closing with the wick on the top, especially on the 30-minute time frame, the idea is that you want the next candle to retrace down first, right? Because whenever you're going to have a candle retrace down, and then when it starts to break the high in the, let's say, the second half of the candle, then there's a higher probability it's going to continue moving in that direction, right? I'm going to repeat it again. First, you need the candle to retrace down to make a lower high. To make a higher low. Right? Because whenever we have an uptrend and when we want, if this is a bullish candle, and when we're expecting the next candle to move bullish, we want to make a higher low, which is higher than the previous low. And when it starts breaking the high in the second half, then there's a higher probability it's going to continue moving bullish. So in this case, what I like to do is okay, since we're breaking the high at this point, my stops are going to be below the current candle. Right? If the candle is breaking its own high in the second half, then there's a higher probability it's going to continue moving bullish without breaking its own low because it's already made a higher low at that point, right? So this gets some time gets used to, so you'll have to see it happen over and over again, or especially if you go back in the charts, you're going to see that happens all the time. Whenever candle closes with the wick on the top, you see it creating a tail at the bottom, and then it starts to break the high. But normally what does happen is that normally what you're going to see is that price will kind of in the first half will move up to create a top wick, and guys are going to say, oh, what, we're moving up at this point, let's take a buy over here, right? You'll take a buy, and then what you're going to see is that, okay, then price starts moving down, right? And then you're like, oh man, now it's moving down. So the ideal case is to let it move down first, right? So it's so if you guys have done programming, right? In programming, there are simple codes, they're like what if statements, right? So the number one what if statement here would be, when you program, is going to be that first you want the price to create a tail and then to break the high. That's it. And the stop is going to be below the tail at that point. So that's how you tackle, candles with no wick on the top, especially on the 30-minute time frame. Next, you have a bullish candle which has no wick at the bottom, right? This means that this candle had so much bullish volume that it didn't even create a tail at the bottom, right? It didn't even attempt moving down to create a tail. When it formed, it just moved bullish, created a range at the top, and that's about it. This is a really good indication that there's a very, very heavy bullish volume in the market. Let it be on the 15-minute time frame, let it be on the 30-minute time frame, 1 hour time frame. Higher the time frame, the better. Right? This does not, now I'm not going to especially talk about the 5-minute time frame, because 5-minute time frames are very, very volatile, they're very variable, and they're weak confirmation time frames. So anything can happen on the 5-minute time frames. For the sake of simplicity, we're only going to go over the 15-minute and the 30-minute. So whenever a candle like this happens, there's a very high probability that the next candle is going to continue moving bullish as long as it respects the low of this previous candle right over here. Right? So we talked about 2 candles with no wicks at the top and the bottom when they're bullish. And the same goes for the bearish candle. So if you're looking for sells, you want the candle to have a top wick and the bottom wick, which is really, really important, because whenever a candle has a wick at the bottom, wick at the top, this is a healthy candle, this is a very normal candle, and there's a very high probability that the trend is going to continue from this point, especially if it's rejecting a zone at the bottom. Or rejecting a zone at the top. Sorry. In the same way, when you have a bearish candle with no wick on the top, this means that there was so much bearish volume that it didn't even move up a little bit. Nothing. Not even a small wick at the top. It moved down. It has a range to fill at the bottom. So this is a very high probability that the next candle will continue moving down. So let's say if this is a 1 hour time frame or a 30-minute time frame, obviously you'll have to look at the market structure formed on the 15-minute and the 5-minute, which we've discussed in great detail in the earlier sections of the course here. Right, so whenever you have no wicks at the top and a bearish candle, that means there's a lot of bearish volume at that point. Now, when you have a no wick at the bottom on the bearish candle, right, price moved down and just abruptly closed at this point. No wick at the bottom. There's a 50-50 chance that price will either move down or it's going to move up. Whenever you have a 50-50 chance in the market, don't look for a trade at that point. I personally don't look for a trade at that point. What I like to see is that, okay, I need a higher probability chance for price to move up or down. So if you have a wick at the bottom in a bearish, this means there's a high probability price can continue moving down. But when you have no wick at the bottom, this means there's a 50-50 chance, and you always need to put yourself in the best possible position to win the trade or to be in the market so the market can go in your favor. So whenever there's no wick at the bottom, there's a 50-50 chance price is going to move down. This is true for the 30-minute, true for the 15-minute, 5-minute. Again, we said it's very volatile. There's weak confirmations at that point. So you may want to stay away from the 5-minute at that point. Because, sometimes when we're really involved in the market, we try to overanalyze the 5-minute time frames, and then sometimes guys look at the 1 minute, and I don't know, things just get really, messy at that point. So we're gonna just focus on the 30-minute and the 15-minute. Now, in this case, again, just like when we talked about the bullish candle right here, you would want to see a candle to create a top wick first, right? And then break the low in the second half to continue down. That's going to be an opportunity for price to continue bearish because it has created a top wick at this point, respected the high, and then there's a higher probability it's going to continue moving down to create a lower high. But if it starts breaking the low in the beginning, right, let's say it starts breaking the low at this point, then there's a 50-50 chance that it may continue going back up like this. So always, whenever you see a candle closing in your direction, but there's no wick, then always wait for price to create a tail. A tail is a wick in the opposite direction that we talked about. So that's the important thing you need to wait for. All right. Now, candle confirmations when we're looking at impulse entries, right? So the first thing is small body candles. These are the trades that we've taken a lot of times in the past, a bunch of times in the live streams, and we've talked about these in the simulations as well. So in uptrends, you want to see bigger bullish candles forming for a continuation, right? Simple concept. Whenever price is trending bullish, you want candles to continue bullish and you want them to create a high so that there's a support formed and then we can retest the high, right? Very simple concept. We've done it. We've seen it. It makes sense. If a support is formed, usually it means the high will be retested. Right? Simple concept. Those of you who don't know about this concept, we've talked about this in the earlier sections of the course. You may want to go over those. A formation of a support by a strong bullish candle is very important. So whenever price is trending bullish, right, it's always going to create a high when there's a lot of volume in the market. And then there's going to be a retracement, right? So we make a high, we come back down, retrace, create support, and then once price creates support, we want a really strong bullish candle closing at this point, right? To say that, okay, now there's an opportunity for the next candles to continue up. This is what we want to see whenever support is formed, right? But sometimes, the candle is not closing that strong of a bullish one. So then we need to see what's going to happen. So if the support is formed with a small bullish candle, then the probability of continuation decreases. Hence, counter trend impulse entry is considered. Right? This goes to show that whenever you have, let's say, a support right here, and candles are moving up, you have another one, we move up like this, and then there's a bit of a retracement, price comes down, we move further down. Actually, you know what? We're going to talk about this here. So let's not draw these. All right, perfect. So you have a candle moving up. You have a bullish candle on the chart. Let's say we're moving above from support, right? And then you have another one, we move up, we move further up, we're bullish. Now at this point, taking a buy at the high right here is not going to be advise it at all, because if you take a buy at the top, this means now since we moved away from the zone, there's a high probability that there's going to be a retracement after it. Now, in some cases, let's say we talk about gold or pound yen or pound AUD, when price has a lot of volume and price is really rocking and rolling, at times you may get strong continuations because those pairs have a lot of volume, right? But generally, it's not good practice to do that because, there's a high probability we may start retracing, right? So, and then we have a candle closing bearish. Whenever you have a candle closing bearish, this means we have a resistance formed at this point, right? So from this point, we have to wait a little bit. We wait for a retracement, price comes down, price comes further down, and then we have a strong bullish candle formed at this point. So let's say we have a strong candle formed at this point, and then now this is a support formed. Whenever you have a candle closing in the opposite direction, that means a zone is created at that point. Now, again, this is not true. Well, kind of true for 5 minute, kind of true for 15 minute, but it's really important for the 30-minute confirmation, 1 hour confirmation, because the higher the time frame confirmations you have, the higher the probability is going to be that the trade is going to work out, right? So price comes down, one candle closes bullish, boom, you got support formed. Now, notice how this candle is a nice, healthy, bullish candle. This means there's a high probability for the next candle to continue bullish, right? Which is going to be, it's going to move up and you're going to have a nice trade and you'll say, okay, like, you know what, price did what it expected to do, worked out perfect, right? Now, second scenario, right? So this is where we talk about that whenever, actually, let me go back here a little bit. So this is what we talk about when you have a support formed, right? And price is going to move up. Now, let's say if someone is looking for sells, right? If let's say someone's not looking for a continuation to go up, but they're looking for sells. When you're looking for sells, you want this support to break right here for price to move down, right? A lot of times what guys are going to do is that they will sell after one bearish candle. So when you sell after one bearish candle, one candle closing in your direction does not mean that the trend has changed, right? You may get some sort of so this is just a retracement. Whenever price moves up or whenever price moves down and you get one candle closing against you, that doesn't mean the trend is changing. That means that that there's room for some sort of retracement, right? A retracement is going to happen. If you get some pips in this retracement, that's all perfectly fine. But the rule of thumb is to always sell when you have a support broken, right? So at this stage, you have a support formed. So the only time you would want to sell is that if we break this support, because if we break support, that means the trend is kind of like changing a little bit, because whenever you have an uptrend, uptrends are going to make, higher lows and higher highs and so on and so forth. So right here, we made a higher high, came down, we made a higher low. If this higher low is broken, then you can say, okay, now price can continue moving bearish, right? That's the only reason, just look for sells. And the same goes for buys, right? So whenever you have candles moving down, right, and we're creating a resistance, you need price to break resistance to continue moving bullish, right? So it's basically exactly the opposite of when price moves up. So let's talk about small bodies here, right? So ideally, this is what we want to see when we want price to continue moving bullish. But let's say that you have some sort of a retracement, right? Retracement, candle closes bearish, and then you have a small body candle closing like this, right? So now, since this is a bullish candle, right, and a bullish candle forming after a bearish candle means that there's a support formed, right? Now, notice how big of a volume this candle has right here. There's a lot of volume here. There's a lot of volume here. This candle is closing a weak bullish candle, right? This means there's bullish volume, but it's not enough for the next candle to continue moving bullish. Now, I know this question is going in our mind, okay, how big the candle should be? Should the candle body be bigger than the previous body or the wick and so on and so forth? Generally, it's based on intuition and experience. What I like to see, now what I personally like to see is that I want this candle body to be smaller than the previous body candle. It should be small enough for me to say, okay, like, this is a bullish candle, but it's small bullish candle. So it means there's not enough bullish volume to continue up. So at this stage, I may look for an impulse entry if the next candle breaks this low right over here. Right? So we've seen this happen a lot of times. And then what we may see is that something like this happens at this time. Right? Now, when this happens, either guys wait for this candle to close below support, or once you see this small body candle closing, you may enter at the break of the low. So whenever you're entering at the break of the low, you're expecting price to continue making a lower low, because once it's breaking the low over here, it shouldn't have any business breaking its own high at this point. So that's where the stop is going to go. It's going to go above the current candle that's breaking the low of the previous candle. So whenever you're taking impulse entries, they mostly work on your 30-minute time frame, your 1 hour time frame, because if they're breaking the lows, there's a high probability it's going to continue making a newer low, and you can have a stop above the current candle at this point. Having the stop above the previous candle, it's still okay, but like if the stop is too big, then it's better to have it above the current candle, especially on the 30-minute time frame or the 1 hour time frame. 15-minute time frame, yet again, like if let's say, for example, this is the 15-minute, there's a very high probability that if you're entering at the break of the low over here, and this is the 15-minute, the 15-minute candle can continue up and break its own high. Why? Because 15-minute is a weak confirmation time frame. Right? I repeat, 15 minutes is a weak confirmation time frame. Only look for this on the 30-minute or the 1 hour time frame. There's a higher probability it's going to work out. Right? And you want to see a small body candle closing at that point. And the same goes true for bearish candles. So let's say that we have bearish candles coming down like this, right? We have bearish candles come down, and then we have a bullish candle kind of like, go up like this. We're moving up again. And once we start moving up, and then you see a bearish candle closing with a small body like this, right? Now, this would generally mean that's a small body. So if the next candle, which is, let's say, a bullish candle, let me bring it up right here, it starts breaking the high, because that was a small body means small volume, then there's a higher probability that the trend is changing and we may start moving up at that point. So it's the complete opposite of this scenario when we're looking at, bearish, and this is obviously bullish. So the key point is that when you're looking at impulse entries, you're looking at candles which have smaller bodies, right? Weak candle bodies mean there's a high probability that the trend can change here a little bit. Good? I guess very good. If you have any questions, write them down. At the end, we will go over those questions. Now, see, and then price starts to move further down at that point. So now we're going to look at some examples here. So a very good example is right over here, right? We have support forming at this point. We have candle rejecting this area. And notice how this body is smaller than the previous candle at this point, right? It's a small body. It does not mean a trend reversal. It does not mean that price is going to go up because the body is smaller over here, right? You have huge bearish volume. Again, you have huge bearish volume, and then you have a smaller bullish volume. Smaller bullish volume means there's less volume for the next candle to continue moving up. So let's see right over here. Right now you have candle closing bearish at this time, right? When a candle is closing bearish at this time, just by looking at it, there's a very high probability price can continue moving bearish. Even though we have a support at this point, this is where we can turn around and say that, okay, so let's try to read the candles here, right? So you had bearish volume, and you had this wick fill here. This candle tried retesting the support, but it rejected it, but it closed with a smaller body candle. Next, you had a bearish candle, which broke the high of the previous candle, but it also closed bearish. Now, there's a high probability for the next candle to go bearish, but there's a support at this time, and we need for this support to break. We know trend is bearish. We know price can go down. There's no bias at this time. Sometimes what's going to happen is that you look at the chart and you're going to say that, okay, like, you know what, there's a high probability for price to continue moving bearish, but we can't take a sell. Even though it's going to go down, we can't take a sell because we have a support, right? Sometimes guys do take sells, but sometimes, you know, we tend to wait, you know, and then you have a candle that closes bearish below the support, and now you know there's an even higher probability for the next candle to go down because we're breaking the support. And all the examples that we're going to talk about are going to be, let's say, your gold or pound yen or pairs with really, really high volume, right? So now, this is what we got right over here, right? We have a candle that's closing a weak bullish candle here at support. Does this mean price is going to go up? Probably not. You know, it's a weak bullish candle. A good opportunity could be when we break this low for price to continue moving down because we have a weak bullish candle at support, right? If this was a stronger one, if let's say that this candle closed, for example, let's say like this, then you could say, oh, like, you know what, we're in this range over here, we're rejecting the support and blah, 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 blah. But, you know, it's a weak bullish candle at this point, so it's a less volume to go up, right? And then you have a candle closing with no wick at the bottom, right? Now, when a candle is closing with no wick at the bottom, what do we talk about? The only reason it's going to go down if it creates a top wick first and then it breaks the low to continue moving down. That's the only reason it's going to go down. And this is the trade we executed on, I think, on Tuesday or Wednesday this past week. I think this was at NYSE Open. So when we look at the next candle made a top wick. It broke the lows and continued moving down. In this case, again, like we talked about, the stop would have been above this current candle right here, and the anticipation is going to continue moving bearish, right? So impulse entries are very, very delicate situation. It's going to take you a long time to really master them, but you have to watch them happen over and over and over again, right? So we talked about the small bullish candle at this point over here. And then, you know, price retraced and whatever start to move down again. So now here we have candles moving bullish, right? Candles are moving up. You have a candle closing bullish at this time. You know, some might say, okay, this is a good opportunity to take a buy at this time. So, you know, some might say, okay, let's just wait here a little bit. So anyway, now you have a candle closing bearish, a small bearish candle. You know, this means we have a resistance formed, but at the same time, this candle is not, this candle is not big enough to say that, okay, the resistance is strong. You know, it's a weak resistance because the candle body is really small. You know, this means there's a higher probability for the next candle to go up unless we see a strong candle rejecting resistance. Always understand this, right? Whenever price is at a resistance or whenever price is at a support, you need a strong body candle rejecting that area for you to say, okay, now there's a high probability for a rejection to happen, right? One candle with a small body does not mean a rejection, right? So I've seen people make mistakes at these. You know, whenever price closes with small bodies, you need strong body candles. So what happened at this point? Now, we had a bearish candle and then we have a bullish candle, right? So we've created a support at this time, right? If we've created a support, what's going to make price go down? If this support gets broken by another candle, you know, and this is true for when you have big moves. Oh, where's my arrow? So whenever you have big moves in the market, you know, and there's a bit of rejection happening after a big move, there's a very high probability that entire move is going to get corrected by the next candles coming down. If there's a rejection, right? If this support gets respected, then there's a high probability the price is going to continue moving bullish. So let's take a look over here. Right. So the next candle rejects this area, breaks support. You know, we're coming down to another consolidation area, and then we have clean candle here to the left-hand side. If this is a high volatile pair, let's say your gold or pound yen or pound AUD, sometimes your JPY, then it may continue down to correct this whole move here, right? So this is not to show that it's going to correct the move. This is just to show that whenever price is at a strong zone, you need a strong body candle, which is right over here, which I call the gladiator candle, right? So you need a strong body candle to kind of like reject that area to say that, okay, now we may continue moving down. Sometimes what guys may do is they may say that, okay, we may take sells once we start breaking this support right over here, and a lot of times in live streams, we've done this as well. We've taken sells as we started breaking the lows at this point, keeping the stops within the zone or keeping the stops above the candle right over here, right? Normally, now this happens sometimes too, so let me just remove my arrows here. So normally, whenever you're taking sells at the break of the lows at this point, so let's say your stop over here is going to be around 25 pips, right? So for me especially, and for some people who do like to have the stops between 10 and 15 pips, 20 to 25 pip stop is going to be a pretty big stop loss, right? So normally what I would want to do is when we're breaking the low at this point, I would want to keep my stop within the zone right over here, around 10 pips, 12 pips, 15 pips within the zone at this point. Because if I can have the stop within the zone at this point, what we're saying is that if price is breaking the low, it should not retrace within the zone, right? It should not come back in the zone deep enough to stop us out. If it comes back in the zone deep enough, then that means this is not a valid break and it's going to continue moving back up within the zone, right? So whenever you see your stop is going to be around 20 pips, 25 pips, bigger stop loss, just have the stop within the zone, because if it closes back in the zone, you can close your trade. If it comes back in the zone near your stop loss, you can still close out the trade. But the high probability is that it will continue moving bearish. And this is when, sometimes price continues dropping without, any retests and stuff like that. So you can see price came down over here, closing with a small body here, right? So now another mistake I've seen people make is that when you have a candle closing with a small body like this, they may turn around and say, okay, this is a rejection, and that's true. This is a rejection, but at the same time, there's a probability the next candle can continue down to fill this wick as well. Now, if this is a rejection, we cannot take a buy at this point, right? We can only take a buy if the next candle breaks this high right over here. That's the only reason we can take a buy. If we break the high at this point, then we know, okay, since we're, where's the candle right here? So since we're breaking the high, right, and especially if we have this rejection at the bottom and we're breaking the high, so there's a high probability now price can continue moving bullish. Make sense? Only if we break the high, that's the point for you to take an impulse entry. And whenever it's breaking the high at this point, you can have the stop loss below this current candle. Because if we have this rejection and we're breaking the high, then there's a high probability it's going to continue moving bullish, and there's less probability it will break its own low, which is where your stop loss is going to be. Because if it continues down to break its own low, then maybe that break of the high is not valid, and maybe price is just very volatile. It may start moving up and down at this point. So you always need clean price action to happen. So let's see what happens here next. So, okay, perfect. See, so we didn't break the high. We just continued moving down to fill this wick at this point. Now, this is where your runners come in, right? If you're entering sells at the break of this low, you have a runner running. And when a candle is closing with a rejection right here, obviously, this rejection is also a rejection at this bottom point here. We generally don't know whether price is going to move up or down, because we have a rejection here. And this is where your runners do all the damage here. And you can say, oh, I have a runner. My runner is up, 30 pips, 40 pips, amazing trade over here, But for people who do close at this point, that's still fine because they closed because they had a rejection. And they're like, okay, you know what? We have a rejection. We don't know whether price is going to continue moving up or down. So always wait for the break of the high to take buys, and one big rejection doesn't mean price is going to go the opposite way at that point. All right, let's take a look over here, and then we start to move down and so on and so forth. Okay, candle confirmations with no wicks. right? These are also trades that we've focused on in the live streams. We also focused on, like, in some simulations here as well, that whenever you have candle confirmations and there are no wicks on the candles, whenever a candle closes without a wick, that means there was no volume in that direction, or there was no range in that direction. This indicates that if the next candle breaks the opposite direction, then there's a higher probability price can continue moving in that direction. So let's explain this right over here. So whenever you have a candle moving bullish, right? So all the examples you're going to see are going to be candles moving up, because I like buying price action. I don't like selling, but that's why, all the examples are in buying over here. So you have a candle closing with no wick on the top. When a candle closes with no wick on the top, let's say this is a 30-minute time frame, it's a 15-minute time frame, it's very difficult to say whether the next candle is going to break this high or not, unless it creates, a smaller wick first, and then it starts breaking the high in the second half. If you guys remember, we talked about. So at this point, you're kind of like waiting for the next candle to form. So let's see over here. And let's say the next candle forms like this. You have a bearish candle with no wick on the top. This means that there's so much bearish volume that price didn't even create a top wick on this candle. It just went down. This means there's a higher probability that price will continue moving bearish after this price. And then you have a candle bouncing around and starts to go down, and so then now you have a very, very strong resistance formed. Whenever you have scenario where you have no wicks at the top and we're creating resistances, those are really, really strong resistances. But at the same time, so let's say you have a resistance right over here. At the same time, let's say you have one candle that starts breaking the high at this point. This means this is a good opportunity to enter a impulse entry, because now we're breaking the strong resistance, and there's a high probability for price to continue moving up and close above this resistance to maybe go bullish at this point. Let's take a look at the scenario that we want to talk about here. So perfect. So you have a candle moving bullish at this point. You have a next one moving bullish with no wick on the top. And then you have a candle closing bearish at this point. Now, there's going to be an opportunity when the next candle starts breaking the high of this candle with no wick on the top, and it may look something like this. I know a lot of you guys have taken trades like this, right? When a candle forms with no wick on the top, and when the next candle starts breaking the high, you're like, oh, you know what, we're breaking the high, we may want to enter an impulse entry, and having the stop loss below the current candle in the anticipation price is going to continue moving bullish. And sometimes, I do get charts of like, hey man, I missed this trade, I don't know how I should have executed on this trade, I missed it, and this and that, and then I started to enter on the next candle, and price kind of like jumped around here and there, and I don't know what happened. So if you've looked at the charts at this, you see that there was a big candle that moved up. You can holistically say that, okay, if this candle breaks the high of the previous candle, maybe that's where we can enter a buy at that point, and having the stop loss below the current candle. So it may look something like this. You enter a buy at this point because we're breaking the high, but the condition is it has to make a tail first. It has to retrace, and it has to make a higher low first before it breaks the high. Because if it creates a small wick first at the bottom and it breaks the high, then there's a higher probability it's going to continue moving up, and you can have the stop below this current candle, right? So this is another opportunity that I look for impulse entry. So we talked about two opportunities at this point. We talked about when a candle closes with a small body and it moves in the opposite direction, and we talked about when the candle closes with no wick on the top, and it goes the same way for when you have candles closing. Let's say you have a bearish candle moving like this, and then you have a next bearish candle that sometimes moves like this, and then you have a bullish candle that, let's say, closes with no wick at the bottom and it closes like this, right? And then what you may find is now you have a support formed at this point, and if the next candle is a bearish one and starts breaking the low at this point, let's say like this is going to be your impulse entry at this point. right? We've seen this happen in the charts. We've missed trades like this as well. And whenever I've missed trades like this, I always look at this and say that, okay, how could I have entered this trade? Even though if I was waiting for a confirmation, I didn't get any confirmation, price just dropped with a lot of volume, I don't know what happened. How could I have entered this trade? Now, it's very logical to say that, okay, if price broke the low at this point, the most logical way to enter the trade would have been once we started breaking the low, and we've made a high at first, our stop goes up over here above the current candle, and entry goes as we start breaking the low, and and then price goes in profit. You want to secure profits or hold it, that's all up to you. But we're only talking about impulse entries at this point. This is where the most perfect impulse entries go when price moves like this. And this only happens when there's volume in the market, and we all know when there's volume in the market, you have your Asian Open, pre-London, London Open, pre-New York, New York Open, NYSE Open, your London close, and so on and so forth. Looking for this in the afternoon session now. A lot of times, what guys do is they look at the afternoon for New York and they start to analyze charts at that time, and they send me charts. They're like, hey man, I'm looking for this opportunity at this time. I'm not trading, but I'm just practicing. That's bad practice, because now you're looking at the chart when there's no volume at the time. So price may not move the way you want it to move. So just don't do that. That's not going to help you out at all. Only look at price when it's time for you to trade. Just like when you go to work, you do your job, you come home, and you don't think about work. Trading is the same thing. If you're going to be trading in the early morning, let's say 6 a.m., let's say at night, you only trade during that time. You don't look at the charts at any other time because your work is done. There's no point. No one goes to their work at night just to see, oh, let me see how the office looks. No one does that. We just stay home. Oh, this is not being recorded. Oh my God. Nah, just joking. It's being recorded. All right. So let's say you have a chart like this here, right? You have a candle coming down. We're breaking below the support over here. Right over here, we're breaking below the support. Candles moving bearish, and now we're looking for the next candle to break the low at this point for price to continue down, right? Because if we break the low, now this is another mistake that people make all the time, that when you have a candle closing bearish, they'll take the sell as soon as the next candle forms, right? Never do that. Always take the sell when the next candle breaks the low right over here. Right? That's when you're going to get a much better confirmation. Because if the next candle breaks the low at this point, then there's a high probability for price to continue moving bearish because it's already breaking the low to make a lower low, right? So let's see what happens with the next candle right here, right? See? So we broke the low, you'll take a sell, price comes down and it moves, whatever, and you're going to have a good trade. But let's say you missed this trade. Right? Let's say you missed this trade and now you're like, okay, you know what? Now the candle is closing with no wick on the top. It's also closing below this support. So I'm going to wait, and what if the next candle starts breaking the high over here, right? Then that would mean there's an opportunity for price to go up. So the more you see this happen, the more instinctive you're going to get in taking this trade, right? If you're new, if you haven't seen impulse entries, if you don't understand how candles break these highs and move, then it's going to take you some time to kind of grasp this concept, So when we look at the next candle, you see price breaks the high, you have clean candles on the left-hand side, so there's a high probability price is going to continue moving bullish. Why? Because number one, we have a rejection at the bottom, right? Number two, if the next candle is breaking the high at this point, this is the perfect opportunity to take an impulse entry for price to continue up. And mind you, impulse entries, they're really quick. They're really quick. You can't wait around for impulse entries. That's what they are. So it takes a lot of practice. It takes a lot of diligent effort to just sit and watch them happen over and over and over and over again and start playing the scenarios in your mind. Whenever you see a candle closing like this with a big wick and a small body, start playing a scenario that, okay, what if the next candle breaks the high? Can I take an impulse entry? And if it does break the high and it moves up, just tell yourself mentally that, okay, you mentally took an impulse entry entry, and it worked out. The more you do this, a time is going to come where you're going to start executing on this, right? You may not start executing full lots on this. You may start executing with a 0.01 or 0.05 with a small lot, with a small risk, just to test it out. But the more you practice it, the more you see it, slowly your confidence is going to go up. And with confidence, your lot sizes are going to start to go up, and then a point is going to come where you're going to find that, okay, impulse entries work for you much better than waiting for candles to close. I know a lot of guys here who only trade impulse entries. Because they want that quick move. They know what they're looking for. Once they happen, they execute and they call it a day. So these things will happen. So you need to keep this in mind here as well. And then, the next candle closes like a weak bearish candle. Now, if the next candle breaks the high at this point, there's a high probability we can continue moving up. But if we don't break the high, then obviously, we can start moving down and start retracing or whatever, right? So yeah, we start retracing here and start to consolidate at this point. Let's see here. I guess this is it for this presentation over here. Let me see if there were more. Let's see here. So we had like this, and there's no next over here. All right, one sec. Let's do this. Oh, my whole thing is broken here. I wonder what's going on. All right, there we go. We're back. Okay, awesome. So now you have a candle, price went up at this time, created a resistance. We have a resistance formed. We have obviously a small body candle closing like this. So at this point, we don't know whether price is going to move up or whether price is going to go down. We absolutely have no idea. Now, when we look at the next candle closes a weak bullish candle. Does this mean price is going to move up? Probably not, because we have a small range at the top, right? But if the next candle starts breaking the lows, then there's a high probability price can move down, and that's where you can anticipate impulse entries to come on, right? So as we can see right here, price broke the low and it continued moving bearish at this time. This is where impulse entries work the best. So whenever you have a candle closing with a small body in opposite direction and we start breaking the low, there's a very high probability we can move down. Now, another question may come that what if you have a candle with no wicks at the top and wicks at the bottom? This just basically means that there was a strong, if you have a bearish candle like this, there was a strong momentum going down. Number one, why? Because there was no wick on the top. Right? So there was a lot of bearish volume coming down. Now, when a candle closes bearish with no wick at the bottom, this means there's no range for the next candle to continue down. So whenever personally I see a candle closing with no wick at the top and a wick at the bottom, I just look at that, okay, we just had one block of candle moving, and now it's a 50-50 chance where the next candle is going to move up or whether it's going to move down. So you can see right over here, you had a strong bearish candle moving down with very, very big strong body, and then you had a small body here, which means the volume is dying a little bit, and then you have another small body here, which means the volume is dying a little bit, and then you have a candle closing a strong bullish candle that we talked about previously, that if you have a strong bullish candle closing at this point, very high probability a support is formed, especially if this is a 30-minute time frame, 1 hour time frame, 15-minute, 5-minute, we're not going to talk about because those confirmations are weak confirmation time frame. So you have a strong body candle closing, very high probability we can continue moving up. But if this was a small body candle, then it would have meant that this is a weak support, and if the next candle broke that low, then there's a high probability we could have moved down at this point. So the next one, we have a candle closing bullish, small body candle. Does this mean we have a strong support? Probably not. The reason why is because we have a resistance formed over here and we have a minor support formed here. And especially when this is a small body candle, this means this is a weak support at this time. A weak support doesn't mean that the support is going to break all the time. We need this low to be broken right over here for price to move down. If we're looking for impulse entries. And the next candle starts to break the low, then price moves down. Obviously, we had some support over here, but we're not looking at the support. We're only focusing on the concept of a candle closing a weak bullish candle and the next one breaking the low for price to moving in the opposite direction. So these are really good when you're looking at counter trend trades. We've also talked about counter trend trades in the earlier sections of the database as well. So if you guys don't know about that, I think it's going to be better to go over those things as well. So small body candles at support means, or small body candles at resistances mean that if we break the highs or the lows, there's a higher probability we can have good impulse trades for price to move. Next one. Now, so this is a small exercise to see how candles form and stuff like that. So now here you can see a candle is closing with a strong body candle. When we're closing a strong body candle, this means this is a strong support over here. This right here was a weak support because the body close was small. Here, the body close is strong, so it means a strong support. This means there's a higher probability that the next candle will respect the low of the previous candle to continue moving bullish, right? So yeah, and then we start to move up over here, really strong here. Now, this really strong means there's a lot of volume coming bullish, So whenever there's a lot of volume going bullish in a candle, this means there's a high probability it will break through zones, right? And then obviously, we start breaking above this resistance here, start making lower highs and higher lows and higher highs at this point, and then we start to move up. So maybe if there was no trade from down at this point, maybe a trade could have been right over here at this point once we start breaking the high over here. And obviously, the stop would be below this candle and we can start to move up, or you can have an impulse entry right over here, which we talk about the impulse entry webinar 1.0 and 2.0. Right, so 1.0 and 2.0, we talk about very, very basic impulse entries in trends, right? Here, we talked mostly about impulse entries in counter trends. And there's only two scenarios. When a candle closes a weak candle, or we close with no wick at the top or no wick at the bottom at a support or resistance, respectively. Let's see over here. All right. So here we have another example of price right over here. So obviously, price is ranging at this point. We have a candle closing with no wick on the top. We have a resistance form right over here. So we need to see how candles are going to form. So this is also a good exercise to kind of start reading candles, Reading candles is also very, very important because it will tell you where the next candle may move at that point. So now you have a candle closing a weak bearish candle at this point, with the big rejection to the bottom, weak bearish candle. This means this is a weak resistance here. Even though, someone might say, okay, I'm not going to take a trade at this point because we have a resistance at this point. You can just look at this and say that, okay, if the next candle breaks the high right over here, there's a very high probability the price is going to continue moving bullish. Whether we break this resistance or we respect this resistance here, the probability is still there for price to move up, so let's see here, right here. So obviously, yeah, we did move up at that point and we started breaking the high and then we, jumped around here and there. So the point is, again, whenever you have a small bodies candles, if we're breaking the highs, there's a high probability we will go the opposite way. So whenever you see prices at a zone, and the candle is a small body candle, that does not mean price is going to reverse. Sometimes it does reverse, but most probably that doesn't mean it's going to go all the way down unless it's a big body candle at that time. you know, and then we started like, you know, jumping around, and then this is a point where you see we broke the high at this point. Once we broke the high, there's a high probability we may continue up to retest this resistance here, because we had clean candles moving down, and once we start breaking the high, this is where you could say, okay, you know what, impulse entry could go right over here. So when you're looking at the live market and we're breaking the highs at these points, there's a high probability we may break these areas to continue in the opposite direction. All right. So I hope some concepts were clear. They weren't that hard. It's just going to take practice. You know, the more you look at the charts, the more you look at these scenarios, the more you're going to start to understand, like, oh, okay, this makes sense at this point, or certain things make sense at, you know, certain points. So it's just going to take you some time, practice, and some sort of intuition over here. So we're going to open up the chat over here to, you know, answer a couple of questions if you have any, and then we're going to move on to the simulation session at this point. All right. So yeah, I think everything was like very clear. You know, should be very simple, straightforward. Is there a max size when considering a weak body? This is something we talked about in the scenario we were discussing.